next rider that we'll look at then is the disability waiver of premium. Disability waiver premium is actually pretty straightforward. What would happen here is we have a client who's been paying premiums. So we've got paying premiums. This client has chosen to include disability waiver premium in their policy. And there are a couple different ways this can work. Sometimes the disability waiver premium is based on the policy owner. Sometimes it's going to be based on another party, a third party premium payer, depending on the circumstances. Whoever it is that happens to be paying the premiums, let's say that this person becomes disabled. This person suffers a disability. Well, in the next module, when you get into disability insurance, you're going to learn all about elimination periods, but here's our first exposure to this idea that we're going to say, in most cases, after you've been disabled for 90 days, so your disability lasts 90 days, at that point you become eligible for coverage using the disability waiver premium, and at that point the insurer starts to pay your premiums, and they will continue to pay your premiums until you get better. At which point, you would resume paying your premiums. Now, once you hit this 90-day mark, keep in mind that you have been paying your premiums for that 3 months. If you fail to pay your premiums over that 90-day period, your policy will lapse. If your policy lapses, then the insurer is not going to pay your premiums for you. So if you do pay your premiums over those 90 days, you meet the 90-day elimination period, you're disabled enough to be eligible for the disability waiver premium, the insurer will now pay retroactively for those premiums that you paid during that 90-day period. And as a note, anytime you have a scenario like that where you have a number of days to deal with, or you have some sort of a timeline involved, I find it's especially useful on the exam to draw out a timeline. You'll find that dealing with clients later on too, that when they have to understand when a benefit will pay or when it won't pay, illustrating a timeline is a very useful way to achieve that. Okay, the next set of riders we'll look at are all kind of lumped together. These are what we call the living benefits riders. And the living benefits riders, and sometimes these are built right into policies today, that's not uncommon. So with the living benefits riders, if we have certain circumstances arise, and you'll learn all about this in Module 10, but if you have diagnosis of a terminal illness, or of a critical illness, or of a long-term care need, then it might be that you can access some of the death benefit or some of the cash value associated with your policy under the living benefits provisions. It's a sickness benefit. It's going to be paid tax-free. You use that money for generally whatever purpose you need, outside of certain long-term care provisions which can restrict you to only using the money for the provision of long-term care services. But the idea here is you've got life insurance, and we're going to allow you to use some or all of that life insurance coverage in order to meet your needs right now. A very common living benefits provision would be you're diagnosed with a critical illness, you're allowed to now access 50% of your death benefits in advance of passing away, and then when you die, your death benefit would be reduced accordingly.